What key risks do you think there are going to be in the FA and the RIA world?
I got good news and I got bad news. Let's see how I can say. The bad news is that half of them are going to lose their jobs. They're going to go away in the next 10 years.
Oh boy.
The good news is the other half that figure out how to get ahead of the curve, figure out how to not do the same old thing that they've been doing in the past, are going to be able to pick up market share, and their books, the money under management that they have, is going to grow. Now, so all you've got to do is figure out how not to be a buy and hold. We're going to do the same thing we've been doing for the last 50-year advisor, how to get ahead of the curve, how to have dynamic portfolios. What I'm doing with my clients is I'm saying we're diversifying trading strategies. We're not diversifying asset classes and buying and holding. You can get through this next cycle, but it's not going to be a 60-40 portfolio with a little gold on the side.
Well, we spent a lot of time talking to people about that. If anything, the tools for RIAs and FAs, for that matter, which to me, a lot of them are just former brokers, and they have cooler names. But they have a lot of different ways that they can get involved in our world of macro, and that's a blessing and potentially a curse. So it's going to be interesting to watch.
They have more tools than ever. It means that they have to educate their clients.
Exactly.
It means that they have to say, we can't do a buy and hold, which means that we may underperform a little bit. You shouldn't underperform a lot. But if you buy the S&P 500, your performance has been in the T-fangs. That's where it's at. Okay, let's not make any bones about it. Well, if you're not buying the S&P 500 as the bulk of your portfolio, you're missing out on that, Amazon, Microsoft, Google performance. I mean, what they add, something like 0.83 trillion or 87 trillion this last month. I mean, it's been ridiculous. That's the growth. Which means that when it rolls over, that's where the losses are going to be, or potentially anyway. So you have to educate your clients. It's going to take more work, and you really, really have to diversify your risk in your risk portfolios.
Now there's there are a couple questions that are along the same lines, and as a follow-on to that, how do you get your readers to navigate a market in which you see long-term and short-term indicators pointing in the opposite directions?
Well, if you look at the portfolios in my own book today, we are, in February, we were 95% long equities. Today, we're 55 to 60% long equities. And I'm fully cognizant of the risks. I mean, we've taken some risk off the table, but I manage a team of, it's basically quant traders. They're investment advisors, they're not hedge funds, but in my hedge fund portfolio, my personal hedge fund portfolio, they do the same thing. They're quants, and they're diversified trading positions. And they're not just 100% net long, and they're willing to change their positions, and they have systems, they have quantifiable systems, algorithms, which say, time to take more risk off the table, maybe it's time to add more risk. They have systems that balance their risk. And they diversify among asset classes. There's a lot of ways to diversify trading strategies. I mean, every one of your clients and readers at Hedgeye have their own favorite ways of diversifying trading strategies. And you could create a portfolio that would perform similarly to me, that has none of my elements in it. Mine is because it's easy and I can bring it to the average person. If you've got somebody that's worth 200 million or it's a big pension fund, then they may want to diversify in other ways because they have more tools available to them than the person worth $200,000.
Yeah, not only do they have more tools, but to your point, there's a tremendous amount of education. And then Wall Street, in all of its creative glory, has created plenty of instruments that reflect growth slowing environments. So,
Right.
obviously, when you have a view that the economy is starting to slow, you can have a growth slowing portfolio. And that's, we do spend a lot of time with clients on that. I think that's, when you talk about the 50%, I don't know if it's 50 or it's 80, and we affectionately call it the old wall that's going to go away. That's the old wall that will go away. The people that actually have no clue on how to pivot out of the FANG and into growth slowing oriented asset classes and exposures.